Welcome, everybody. This is the October IncomePlus Fund Update webinar. I am Michael Episcope, co-CEO of Origin Investments, and my co-host today is David Welk, Managing Director of Acquisitions. David Shearer and I usually host this together, but it is divide and conquer right now because we have a lot of webinars. So we've invited our other team members to do this, and Dave is joining us from Charlotte today. He leads the acquisition team and is really our longest tenured acquisition professional here at Origin. So really excited to have him on today. And Dave is what I would refer to as the gray hair of the real estate department. And he actually does have a little bit of gray hair there as well. Yeah. He's a wealth of knowledge, and much of our track record is a result of deals he's uncovered over the last decade, and I consider him a personal friend as well. So welcome, David. We also have a special guest today, Mike McVicker, Origin's General Counsel, and Mike is going to go over a proposed amendment. We're going to kick off with that in a couple minutes, and then he'll stay on for questions if anybody has questions about the amendment as well. I'm going to cover the high-level fund performance. We have a lot of good news to report. We actually removed the section this update really about delinquencies because it's just no longer relevant as the portfolio is more than 98% current and trending up. It's just a nice sign that we're sort of reached the other side now. Dave is going to cover the debt, common equity, and development portfolio at a high level. He will dive into a deal or two and then talk about the state of the market, give sort of a boots on the ground perspective. And after that, we're going to open it up for the Q&A session. Mike, I'm going to hand it over to you now so you can talk about the amendment. Jeff, please tee up the slides. Thank you.
Great. Thanks, Michael. Yeah, so as Michael mentioned, we are proposing an amendment to the fund's operating agreement that will change the way we measure performance from a per unit basis to a fund level basis. The current fund structure follows a hedge fund model in which each issuance of units creates a separate series from which performance is measured. And at the end of the year, the performance is assessed on a per unit basis. Each series is rolled up into a single series with a unified NAV, and all investors' unit counts are adjusted to account for this roll up and performance allocation process. When we launched the fund, we had a single class of units and anticipated making quarterly distributions and admitting investors on a quarterly basis and issuing units on a quarterly basis. With this relatively simple system, the hedge fund model works. It's not super difficult to manage with a potential of 4 series a year that you need to roll up and account for. However, since we launched, we've added classes so that we now have 4 classes of units, and we moved to a monthly distribution and a rolling admission and issuance process. So this means that we now have at least 48 potential series each year to track and administer. This creates a tremendous burden on our accounting and fund administration. And it also means that we are unable to reflect to investors a unified NAV for reporting purposes. The solution to this problem is to move from the per unit hedge fund model to a fund level model used by other real estate funds with similar investment strategies and profiles. Our amendment will eliminate the need to follow the per unit performance determination, and effective 2022, we'll move to the fund level performance metric. This will reduce the accounting and administrative costs and burdens and most significantly will enable us to accurately report out to investors a unified NAV per unit by class. There'll be more details about the actual amendment when we send out the proposal and the consent, which we expect to do next week. But we just wanted to use this opportunity to give everyone on the call a heads up that this would be coming.
Yeah, thank you, Mike. And I would clarify that this is a negative consent. You don't have to do anything here. If you object to this, then you can state your objection. And the most important thing here is that this is revenue neutral. This isn't, something that really impacts most investors. There could be nuances if you came in the beginning of the year, but overall, it's going to reduce fund expenses and be more beneficial. And what Mike was talking about, a unified NAV, well, the net asset value, the unit price that I'm going to show actually doesn't reflect the performance fees. Those are taken at the individual level. So going forward, the net asset value, the unit price will reflect the impact of a performance fee as well going forward. And so, in an open-ended fund, when you start the fund at a period in time and it's open forever, very different than a closed-ended fund. In a closed-ended fund, if you get some things wrong in the PPM in fund one, well, then you just correct them in fund two. But in a fund that has, that lives into perpetuity, amendments are part of the lifestyle of the fund. So this is really important. We think this is a something that we want to bring out. Obviously, we think long and hard before we introduce an amendment to our investors. All right, thank you, Mike, very much. Let's jump into the webinar now, the fund update itself. And then, Mike, if there's any questions about that in the Q&A, we'll let you address those. So, Jeff, please put up the slides again.
Hi, Michael. I apologize. Having some technical issues. I'm trying to transfer the deck over to David Welk so that he can share them. I apologize.
That's okay. Let's just put it up the way it is now.
Okay.
And we don't have to expand it. I saw that it was closing on you.
Sure.
And I can begin anyway. I don't need the slides for this part. So the webinar is open to both new and prospective investors. As you know, we welcome both of you. And if you don't know a lot about Origin, I'm going to give you kind of a 2-minute version here. We exist to help high net worth investors grow their wealth and generate passive income through real estate. And that's what this fund is designed to do. The 3 pillars that define Origin are alignment, our ability to execute, and our team. And that's always been the case for the last 14 years since we began. Alignment is, everything sort of revolves from this. And it's always been important to us because we believe that people should win and lose together. And that's how you build a firm. It's the right way to do business. And it starts with David and I investing a significant amount of our capital alongside of investors, and then how we compensate our team in terms of performance. And we want to make sure we are all focused on one thing, and that's generating investment returns. And that's what we've done. And our ability to execute is really captured in our track record. We are a top ranked manager. We're very proud of that. Preqin is a third-party ranking system. They put us really in the top kind of 2% out of 2,000 managers. We just found that out, I think about 2 months ago. So very proud to be there. We've never lost money on a fund deal, and we pride ourselves on being really good risk managers and locating great opportunities, adding value, and understanding, how to maximize upside. Now, candidly, Fund 3 had a lot of office in it. So, it's not just about multifamily. Multifamily has done well throughout the last 14 years. We've done retail, we've done office, we've done student housing even. And even in our Fund 3 portfolio, we've had some office that has done extremely well, actually generated more than a 2x, and some office that's probably going to generate, right around a 1 or 1.1 multiple on that. So, when we lose, we really want to see a scratch as the worst case scenario. But I'll say that when we've won, we've done far better than what we've expected. Our internal stated vision to the entire team is to maintain our status as a top performing manager. It's really important to us. It's not about growth for the sake of growing. We want to give people opportunities, but it's growing while also maintaining our value proposition at all levels. And that brings me to the third pillar, which is we have a team of 35 incredibly talented people here at Origin who make all this happen. And many of them come from institutional backgrounds. When you invest here, these are the people who are helping to put your money to work in great projects. And what they all have in common is that they work really hard, they're smart, they believe in the mission of the company, and what we're doing is important to our more than 2,000 individual investment partners at Origin. So it's a, just wanted to kind of say that if you're not familiar with Origin, if you are, these are probably a lot of the reasons why you invested. Let me jump into the fund overview now. And the next slide, please. Thank you. The fund's primary purpose is to deliver tax-efficient, stable income and appreciation to investors. Target annual return is 9 to 11%, which includes both yield and appreciation. And we launched this fund about 32 months ago, right around 2.5 years ago. And the fund operates as an open-ended multi-strategy fund that builds, buys, and lends to multifamily properties in growth cities around the United States. Now, in previous webinars, I did talk about the buying portion, how we weren't doing. There's always exceptions to the rule. And David is going to talk about our pipeline and one of the exceptions to the rule. Now, this report that you see in front of you is as of 9/30, and the fund just crossed the $200 million mark. The portfolio is allocated 23% in cash and marketable securities, 30% in real estate common equity, and 47% in real estate preferred equity. Now, much of the cash in the fund is earmarked for near-term deals that are going to be closing. But because of our cash position, we have actually temporarily closed the fund to new investment. Now, new investors, you can still subscribe. You will be in a queue. And it looks like we will call capital to anybody entering the queue today around February. Now, that could slide by a month in either direction, depending on our pipeline and what deals get closed. But deals get pushed back, deals show up last minute. There's a lot that can happen. We're just trying to give you as much guidance as we can here. The end of September unit price has been calculated at $10.62, and that's up from $10.48 last month. So a nice gain month over month, and about 85% of that gain is attributable to our common equity portfolio. And valuations in our markets, they've just continued to accelerate over the last several months. And I believe there is more room on the unit price to run, and really for two reasons. Number one, we are pricing assets fairly, but the market is moving so quickly that information as old as 90 days can be stale. And that's what we're basing valuations on, our recent trades in the market. But when you look at the trades that are happening today versus 60 days ago, the market is really moving extremely fast. And the other reason is that our preferred equity is generating a yield, kind of an average yield in the portfolio, 12.5 to 13%, which is highly accretive because it far exceeds our distribution yield of 5.7% today. So I think you're going to see continued good news in the unit price as a result of both these factors. Now, in terms of the risk or health metrics, we're in really good shape there as well. The common equity leverage has actually fallen to close to 55, 56% as a result of valuations going higher. And the debt service coverage ratio now sits close to 1.5x. So plenty of cash flow that's being generated from those common equity investments. And the fund is well diversified, is at 12 total assets in the fund, and that's only going to grow this year and next year. Next slide, please. So historical performance. This fund shows historical performance against the Odyssey Core Equity Index. And this is a levered private real estate index. This is our benchmark. And returns, they really have to be measured against the benchmark because there are times when a 10% loss might be a really good outcome. And there are times when a 10% gain may not look that great if the index is up 15%. So we really believe in measuring ourselves in all parts of the organization against the benchmark. And that extends from the acquisitions team to the investment management team to marketing to our investor relations team. And it's, you know, important as a tool to really understand how you can get better and what your competitors are doing. So in this case, we beat our benchmark in all really but one quarter, tied it in a couple quarters. And we've had a really nice 12 months with the fund gaining around a little more than 19%. And that's inclusive of distributions. And over the last 2.5 years, we've actually generated close to a 9% annualized net return to investors. And that includes the dip during COVID. So many of you have come into this fund because you wanted to both have exposure to private real estate and also get away from stock market volatility. And it's really doing what it's designed to do, which is produce that consistent income with minimal volatility. And mind you, that this includes that portion of COVID. So, you know, that bogey of 9 to 11%, we're going to have some great years where the fund might produce 15, 16%. 19% is really out of the norm. So if you were lucky enough to get in last year, you've done very well. If you've been in since the beginning, the fund is doing what it's supposed to do. The fund has paid out dividends every month since inception at a rate of 5 cents per unit. And our original target was a 6% yield, but with the increase in the unit price, the yield is now dipped to 5.7%. That's still very generous in today's world when you compare it to other income products and well within our target range of 5 to 7%. I do have some good news to report, and that is we will be raising the distribution yield in January by about 5%. We haven't totally solidified that yet, but it's really important to us that we're not only growing unit price, but also growing the dividend year over year and keeping at that 5-6% annualized yield. So let me jump into the last slide that I'm going to cover, which is operational highlights. And this is a 12-month snapshot of the operational highlights of the common equity portfolio only. The orange line is occupancy and the blue line is revenue. And they say a picture paints 1,000 words. And when you have a revenue chart that starts in the lower left corner and ends in the upper right corner, that's generally very good. And I really couldn't have hand drawn this any better. So our occupancy has risen in the last 12 months from about 88%. Portfolio, you know, COVID impacted a lot of the occupancy out there. And, you know, at that time, it was also, we had a lot of collection issues. So the revenue was really depressed. So today our occupancy is just above 96% and our revenue has grown by more than 20% over that same period. So the portfolio is doing very well. We're able to continue to produce the distribution yield, grow unit price. So a lot of good news. And now I'm going to hand this over to Dave, and he's going to talk about some individual deals, the makeup of the portfolio, the breakdown, state of the market, and then we'll open it up for questions at the end. Thank you, Dave.
Thank you, Michael. And can you hear me okay?
Yes.
All right, I've got an echo in the background for some reason. If anybody questioned whether we were doing this live, they know now that we are. Good morning, all. Good to be with you. We'll jump into the portfolio highlights here and see how long I can deal with this echo in the back of my ear. As Michael mentioned, I'll provide a brief overview of our current acquisition pipeline for our fund investment opportunities, which includes about $91 million of potential equity deployment across 7 investments. And then I'll provide a quick state of the market on operations, construction, and lending. We'll get started here first with Monroe and Aberdeen. We averaged about 93.4% occupancy during the second quarter or the third quarter here, just below our comp set average of 96% during the quarter, but we ended the quarter ahead of the market at 96.7%. During the quarter, we retained 37% of the expiring leases compared to our competitors' renewal trade outs of about 50%, which was due to a significant increase that we pushed rents over the course of the quarter, which since January lows have represented a 35% increase. And this was actually evidenced in our renewal trade out rent increases of 6.5% versus our comp set average of 5.7%. And the operational recovery here over the past 10 months has been quite impressive. And we will continue to push rates and implement parking charges to increase additional income over the year. The next asset that's included on the list here is Madison and Westinghouse. This asset continues to represent one of the strongest performing assets in the entire fund. We averaged 97% occupancy during the quarter, and our average renewal trade out during the quarter represented a staggering 12% increase while maintaining that high occupancy that I just referenced of 97%. And this renewal trade out increase is 33% higher than our comp set average. So we've significantly outperformed our competitors, and all the while retaining 63% of our residents, which is 9% above our competition as well. And as I mentioned in a previous webinar, we will continue to move the valuation of this asset forward as operations continue to improve and we eliminate the loss to lease from these significant rent increases. Excited to update you all on the District at Memorial performance. As some of you have seen, this asset has lagged operationally over the past couple quarters. It was hit particularly hard by COVID. Houston as a market also saw some challenges from a capital markets perspective and valuation perspective. But we will be writing this asset up significantly over the quarter due to a significant improvement both in the market and property fundamentals. The submarket itself, which is the Energy Corridor, Memorial City Corridor, occupancy held stable for the quarter at 94%, which is a significant increase from the first quarter, which was around 89%. And at the property itself, we are exceeding the market at quarter end with 95% occupancy. So we are fully stabilized from an operational perspective. We achieved a 5.3% increase in trade out rents here, which is slightly ahead of the market, but we've significantly outperformed the market with our retention of 60% versus 52%. And this is a marked improvement from where we were performing at the property level at roughly 42% in the second quarter. As we mentioned previously, the upgrades to the exterior amenity spaces have been completed, have been well received by the residents. The rooftop pool with brand new outdoor kitchen and exterior lighting has been well received, and we completed the pool refresh for summer use. The next series of updates that I'll be providing here represent our build-to-core portfolio. And for those of you who have been following in recent updates, we have executed on a strategy of allocating up to 20% of the fund's capital to development projects that we will hold long-term. And first on this list is Charlotte Avenue. We reported out on this one last quarter. This represents our first build-to-core asset. It closed in July. And this is in partnership with PDG, who's a strategic relationship of ours. They're a vertically integrated developer, meaning they have in-house general contracting capabilities, which allows them to maintain a very tight control on schedule and costs. And we believe that this is a competitive advantage in the marketplace. In total, this will be about a 302 unit project located about 7 minutes from downtown Nashville. And it's walkable to a number of neighborhood amenities, including L&L Market, which has over 20 high-end retailers, and Sylvan Supply, which is a very successful adaptive reuse project and has a lot of neighborhood amenity demand drivers. Additionally, Publix has announced that they will be going in just over a block away, which will be great news. They'll be walkable to the project. And other employment drivers, including Oracle, who purchased land in Nashville and will be building out over a $250 million campus with their regional headquarters, adding up to 8,500 jobs over the next 5 to 10 years, is a short drive from the project. Construction kicked off in late July and is anticipated to last approximately 24 months. And project amenities will include some submarket leading courtyard, 2-story pool, fitness center, co-working lounge with private booths, and a 2,000 square foot sky deck. Unit finishes themselves will include granite countertops throughout, stainless steel appliances, full-size washer and dryer, and commensurate with Class A finishes in the marketplace. Linden House and Horizon, which are the next two on this list, are both new partnerships with Rise Development, which is based in Georgia. The first one that we closed here was Linden House. This is a 295 unit garden project that marks Origin's first investment in the Jacksonville MSA. This is scheduled for a February 2023 delivery date and is located about 25 minutes from downtown Jacksonville at the intersection of Racetrack Road and Highway 9B. It's in the Bartram Park neighborhood, which is walking distance to Durbin Park, which is a 1,600 acre master plan development project with a hospital, which will be a great employment driver for residents here, and a number of park space and other employment nodes located throughout. Specific to the project, we'll have 2 resort style pools here, courtyards, club rooms, fitness center, and then other on-site amenities and very similar finishes, again, as we mentioned, to the Nashville project. Horizon will be the next deal in our partnership to close with Rise Development. That is set to close in the next 2 weeks, and it will be our first development project in Tampa, although we did close a pref equity investment for the fund that will be a we closed on that 3 weeks ago. This will be our first equity investment. So the project's located on the front edge of DG Farms, which is a 280 acre master planned community as well. And the site will be improved with 4-story elevator served buildings, 320 units in total, 100 covered parking spaces with 32 garages. I think the most unique attribute about this project is that we will be providing golf carts to residents where they can access nearby retail. Construction timeline here is a little bit faster than some of the other projects. It will be about 18 months. And we're excited to get that one kicked off, as I mentioned, the next couple of weeks. The last project on the list here has got a special place for me, as I've spent the last 6 months bringing this project to life. We are partnered with Atlanta and Miami-based Kaplan Residential, who we are trying to build a much more programmatic relationship with over a number of deals throughout the Southeast. Kaplan spent a part of 2 years entitling this project. It's located in Belmont, North Carolina, which is suburban Charlotte. It's about 15 minutes from the international airport here and 25 minutes from downtown Charlotte. And it represents one of the most desirable bedroom communities in the area. It's well known for its high quality schools and its dedicated downtown, which you can't look at too many locations throughout Charlotte where you have this amount of retail that has its own vibrant, self-contained atmosphere. And the project itself is walkable to this downtown. It'll be 322 units with a 3-4-story split design, along with some very desirable townhome units with direct access garages. And we are set to kick off development of the project literally this week. I will jump into the preferred equity portfolio. And not to spend a ton of time on any one individual deal, I'm going to talk at a high level about these 7 investments. And I'll point you to the annual yield column and the coupons here. And if you compare that to what we will show on the next slide in the pipeline, it tells a story of the competitive landscape that exists in the market over the past 2 years, which has led to continued yield compressions. So Star Metals and Aspire at Westminster are the 2 projects that represent our first investments in preferred equity into the fund. And as you can see, their annual yields are in the 13% range. If you compare to the yields that will be shown on the next pipeline slide, where we're currently competitive in the marketplace, those yields have compressed down to around the 11.5% to 12.5% range. So we expect this trend to continue going forward, but we do have minimum yield targets that we're solving for. So we really can't push much more below that 11% range to still achieve our target returns. And one of the most attractive elements of our structures that we have embedded in most, if not all, of our preferred equity investments is a multiple floor. And for those of you that aren't familiar with what that term means, it basically guarantees, irrespective of time of the investment, a minimum return for our capital. So those minimum multiples can range somewhere in the range of 1.25% to 1.4. But just like the annual coupons, those multiple floors have continued to move down as well. Our early investments in Star Metals and Aspire are benefiting from this substantially because those are being paid off early, and both Star Metals and Aspire we expect to be retired in the next, well, Star Metals has been retired in the last few weeks, Aspire in the next couple of weeks. But those multiple protections that I mentioned will provide us with IRRs that are much greater than the coupon rates of 13%. We expect those to produce a mid to high teens IRRs when they are retired. So we will continue to remain active in the space, as evidenced by the 6 pref deals on the pipeline. We believe these investments continue to represent some of the best risk-adjusted returns in the marketplace because they generally sit in the 80 to 85% cost of new construction, which is about 30 to 40% below current trades that we're tracking in the marketplace for stabilized product. So in theory, this produces a 50% edge of protection to values in the market. And we have built a number of strong relationships in the marketplace with developers and brokers that will yield a strong pipeline of opportunities. But as a whole, the portfolio here continues to perform quite well, and we expect additional payoffs over the next year or so as developers are taking advantage of strong valuations and are retiring our positions early. But we, as I mentioned before, this is going to produce higher IRRs than our coupon rates would suggest due to these multiple protections. I'll jump to the deal pipeline. I've been referencing this for a little bit now, but we've got 7 deals on the pipeline. Most of these are preferred equity investments. In total, about 91 million of total equity commitments. We've got about another 30 to 40 million of equity commitments behind this that are in various stages of the pipeline, but pretty robust and diverse. The one highlight I'd like to point folks to, well, we'll start with the top and the bottom. Both are in Austin. The first one would be the Austin multi-development project, 21.2 million of equity in a 12.25 yield. That is set to scheduled to close next week. And the size of that fits in pretty well because it'll retire or replace almost all of the Aspire Westminster proceeds that'll be coming back to us from payoff. Very excited about that deal. It's in a great location in East Austin, very near the Tesla Gigafactory. And we have a very well protected basis of around $230,000 a unit. And comp trades in the marketplace today are going off around 3.5 a door. So substantial amount of insulation and protection on our basis there. The last opportunity that I'll highlight on this slide is another project in Austin. And it's important to highlight this one for the reason is that this represents the first common equity acquisition deal that we have on our pipeline really since COVID. And we have mentioned before that we're not actively pursuing common equity acquisitions due to valuations currently in the marketplace. But simply put, this opportunity represents a market opportunity to buy something below replacement cost. Those opportunities in this marketplace are almost completely never found. The market is very efficient and developers are generally aware of how much active capital is out there pursuing multifamily acquisitions. So this has been sourced off market by a partner of ours who's based in Texas, who's had a relationship with the developer for a long time and has had this under contract for the better part of 6 to 9 months. So still working through our acquisition efforts here, but if this does make it to the pipeline, this will represent the first common equity investment that we'll have made, again, as I mentioned, prior to COVID. Last slide for me here is a quick update on the state of the market. I'm not going to spend a tremendous amount of time going through each one of these bullet points because we could make an entire webinar out of each one of these. But operational performance, I'll just highlight some of the strength of our existing markets and some of our newly established expansion markets like Las Vegas. So one of the most important factors that weighs in on valuation performance is rent growth, and it's something that we track very closely. We also built an AI tool that can forecast rent growth fairly accurately. But the markets that have been the strongest performers year over year have been Las Vegas and they've seen year over year rent growth in excess of 23%. And Raleigh and Charlotte are right behind, around 20% annual increases year over year, with Austin and Nashville around the 18% level. So these are some staggering performance metrics in the likes that we haven't seen on a year over year basis. Now, some of these have been largely depressed due to COVID, but a lot of this due to the continued immigration flows into these markets from largely northern and in some cases, I'd say Western markets, but predominantly California. The forecasts for next year are still very strong for most of these markets. The expectation is not for double-digit rent growth to continue, but 5 to 7% is largely forecast for markets like Las Vegas, Phoenix, Raleigh, Charlotte, Nashville, Atlanta, and Orlando. So those will significantly outperform what is more common, a 3 to 4% year-over-year rent growth forecast in a lot of these markets. So you're excited about the pipelines that we have in these markets or the construction starts that will exist, because we are not certainly forecasting in any of our models this level of rent growth to occur. On the construction cost side of the equation, as I reported out in the last webinar, the topic du jour was lumber. That went up, went down. It seems to be stabilizing to a degree, and the spot price level right around somewhere between $650 and $750 a thousand board foot. But the challenging thing today that we are working through in real time is engineered trusses, which is interesting enough. It does require lumber for the manufacturing these, but these are basically the roof joists that go into all the roofs of our apartment projects. And it's crazy to believe that this is true, but what is really driving these costs are the metal plates that are used to fabricate the roof trusses. And there's a general shortage of metal and materials up and down the supply chain. And it's been exceptionally pronounced on the assembly of these engineered trusses. So we've seen increases of these trusses anywhere between 140 and 300% from where they were pre-pandemic. So we're working through that. We continue to model significant price increases, escalations, and contingencies into our development projects. But there's other challenges too, just in terms of the general supply chain and lead times that can affect schedule. Like, for example, roofing systems, which are largely TPO roofs, are now upwards of a year in terms of lead time. Whereas pre-COVID, you would order those, 90 days prior to needing the materials to be on site. So we're working with our general contractors and our development partners to get ahead of potential additional supply chain disruptions. We're getting creative in terms of ordering materials well in advance and storing them. In some cases, paying for the cost to store them ourselves, or paying slightly more to our material providers to store the materials themselves, but taking that potential price escalation risk off the table. So over the last year, just to put a number to it, we've seen about a 6% increase in construction costs. And according to a recent JLL study, the market is anticipating somewhere in the neighborhood of 4 to 7% increases over the next year on top of this. So to put this into perspective, and this is something that we've discussed quite often at our investment committee, a $20 monthly increase on $1,400 rents, which is about a 1.4% increase. And as I mentioned on the previous slide, in the previous section, operationally, we're seeing rent increases in our markets in the neighborhood of 10 to 25%. So a 1.4% increase is certainly below what we're experiencing in real time. But that $20 increase in rents on $1,400 rents can absorb a $2 million increase in costs when you capitalize that increase at a 4% cap rate. And in many of our markets, we're seeing cap rates in the low to mid 3% range. So you can see how this math actually begins to work in terms of rent increases can more than absorb these increases we're seeing in the construction pricing market. Don't know how long both of these will continue, both the high increase in rents and also in construction pricing. What we believe that we're in a pretty good position to see attractive opportunities over the next certainly 12 to 24 months. And on borrowing costs, I know this is the last bullet on the slide here. I don't have a ton to update other than the capital markets environment continues to be exceptionally robust. There is a host of lending opportunities between agencies, banks, life insurance companies, bridge lenders. There is a wash of capital in the marketplace, and we're still seeing the record level lows in terms of borrowing costs, which certainly helps to offset, again, as I mentioned before, some of the challenges in the construction pricing market that we're seeing. So with that, I'll kick it back to Michael.
Great, thank you, Dave. Let's take the slides down if you can. I know you're operating those, Dave, and then we'll address the questions. And the first few questions I want to address are ones that were mailed in, and tax efficiency seems to be a big topic that everybody wants to talk about. And there's the tax efficiency of the fund, of real estate, and just taxes in general. So we kind of lump these all together. And for those of you who may not understand, who are curious about the tax efficiency of the fund with all the preferred equity, the way the fund was originally designed was that it was going to be sort of 80% common equity, 20% preferred equity, but with the ability to tactically shift across those as we saw movements in the market. And the common equity was providing the depreciation to the fund, to the REIT, to offset any of the income produced by the preferred equity investments, because preferred equity by itself is not tax efficient. But if we have excess depreciation, we can use that and we can distribute money tax-free to investors. And that's what we've been able to do for the last 2.5 years, is make distributions tax free. We also added to the fund the 20% allocation to ground up development. And the 20% allocation was actually incorporated earlier this year. We talked to investors. We didn't actually need an amendment, but we sought approval from investors anyway, because it wasn't represented in the beginning. So we are bound by that 20% target, and that's about what's in there. Dave went over 5 deals, and the way that we've skinnied those down to only account for, they're a little less than $40 million, about $38 million in fund exposure, is we did a considerable amount of sidecars so that the fund would be diversified across more than just one deal. Because candidly, $38 million, even $40 million of room for ground up development would mean 1.5 deals, maybe even 1 deal. And so, we wanted to diversify the fund. We wanted to make sure that happened. And those are build to core. So those will ultimately go into the common equity bucket. And it's a way for us to penetrate into these markets where we see pricing just getting a little crazy, into the Austins, the Nashville. We can enter them at a much better basis and not compete with the wall of capital that's out there. So the fund has been operating very tax efficient. It is extremely tax efficient even today. Obviously, the more we have it tilted towards preferred equity, the less tax efficient it becomes, but it will still be more tax efficient than a lot of the other opportunities out there. And for us as managers, our first goal is to protect your capital. And we do that by making these decisions. And just because we said, look, originally we're going to do 80% equity and 20% preferred equity, we have to make adjustments along the way and on the fly, and we don't want the tail wagging the dog. So at times this is going to be amazingly tax efficient where there's going to be none. And at other times you might have some taxes to pay. And we're doing what we can on our end to make sure that we're generating the highest risk adjusted returns for you. So I wanted to address that question. That's about tax efficiency of the fund. I'm not going to really opine on what's happening in Biden's proposal right now. And we have a lot of questions that came in about the compliance, the RIAs potentially not being able to invest in private funds. I'll tell you right now, we're going to cross that bridge when we get to it and see what the final proposal looks like, because there's so many things that are thrown in these initial proposals that end up getting thrown out because they're just kind of pie in the sky, wants versus actually, well thought out plans. And one of them was they wanted to do away with the 1031 exchange plan. Well, that's no longer part of the plan because I think some very smart people came together and said that you just couldn't make this happen. Like the amount of jobs and the velocity of capital as a result of 1031 exchanges is just too great. So it's a wait and see. The last question that I'm going to answer before I throw it over to Dave, and by the way, if you have more questions, now is the time to ask us and we'll answer all those. The future composition of the fund, I believe I've answered this already in terms of ground up development is never going to exceed 20% at any one time. And so today the fund is $204 million, the net asset value. And, right now we've got about $38 million in ground up development to the fund. Let me see, were there any others that got a tax efficiency? So no, now we can go on to the other Q&A. And Dave, before you begin, I'm gonna actually hand a question over to Mike because he's been waiting patiently here for about 40 minutes. But Mike, this is kind of funny because I asked you the same question the other day. I have 2 investors who are asking a question about, can you explain the 4 share classes?
Yeah. I think so, although I don't have them right in front of me. I mean, basically, we created share classes last year to allow RIAs and broker dealers to invest their clients in the fund. So there's the general share class that everyone is a part of. And then there are 2 share classes specifically designed to allow broker dealers and RIAs to invest. And there's a separate fee structure in those classes that allows RIAs to extract additional fees for their clients and broker dealers to earn commissions for their investors. And then there's a class that's set up for employees of Origin.
Right, thank you for that. And Mike, I'm going to ask you one more follow-up question, and I think this will be the last one, but the question is about, will any investors' NAVs on the portal change higher or lower based on this reporting change?
So based on the amendment, if it gets adopted, no. So what will happen is we will follow the existing structure through this year. So there will be adjustments made at the end of this year to basically roll all of the existing series up into a unified NAV. So there will be adjustments made this year in accordance with the existing documents. But moving forward, there will not be any change or adjustments or effect on NAV.
Great, thank you, Mike. Those are all the questions, I think, on the legal side related to the amendment. Appreciate you being on today. Dave, any questions you want to take?
Yeah, I'll take the construction related question. Are the construction cost increases, supply chain issues factored into your build to core underwriting? Or are you just hoping that rents overshoot your underwriting to offset any cost overruns? As we like to say here at Origin, hope is not a strategy. While we're experiencing that happening, the way we structure our construction contracts with our general contractors is that we secure what's known as a guaranteed maximum price. So those prices that are assumed in the contracts themselves are guaranteed, with the caveat that due to the increase in lumber over the past 12 months, many of the guaranteed maximum price contracts have been carving out lumber. And so we're taking pretty proactive strategies, as I mentioned in the past, on how we address that. Really, it's in a couple of ways. One, it's through more than adequate contingencies that we're allocating to each one of these projects. Likely they're 3%, but in some cases they're more to 4 to 5, depending on how much risk we believe we are taking on in some of these allowances. And we are also taking the opportunity to watch the lumber pricing market very closely. And we will execute, and actually the PG Charlotte Avenue project I mentioned earlier is a great example for the fund of this happening in real time. We took the allowance when we closed, and we were carrying a very high lumber allowance in our underwriting. We watched the pricing come down, and we locked in the lumber contract post-closing before we needed the lumber on site, and we're saving upwards of 7 figures from what we underwrote. So between contingency underwriting and taking a very proactive approach to watching for opportunistic times in the marketplace to purchase lumber are 2 good examples of how we are addressing this in our development projects.
Yeah, and I also want to say that sometimes you win on these. And on PDG Charlotte, we left it out on purpose, and we underwrote to a $1,700 per board foot lumber price, and we've saved more than $2.5 million on that deal alone. And we knew the deal worked at $1,700. So it's not always, you know, when lumber is at $500 or $700, you definitely have to do your best to hedge these things, but sometimes there is also a way to win on that side. And I'll also add that costs are really important, and I don't want to underestimate that, but a $2 million cost is not as important as the revenue side, because the revenue has a multiplier on it. And if you miss by $100,000 on the NOI, if you think about that being almost a 30 multiplier, that's $3 million in value that you're missing. So even if costs go up by $2 million, if you have rents that are climbing at 6, 8, 10% per year, the margin that you're trying to capture is still protected. And that's what we're looking for. And yes, costs have gone up a lot, and they've gone up this year and last year and the year before. And you can look back in the history of real estate, they go up every year. And as long as your revenue growth exceeds the cost, you're going to do fine. And what we're seeing today is actually development margins higher because of the rent growth and the current rent in the market than they were 2 years ago. So there's a couple offsetting factors, but getting the revenue right is so much more important because of that multiplier factor. Thank you for the question. Let me, Dave, I'm going to take this really quickly. There's a couple that I want to answer. Can existing investors put more money into the fund? Existing investors don't get to skip the queue. So if you want to, you can actually go into the queue. And again, we'll be calling money probably around February with a March 1st trade date. Again, that can go up or back. You can always reinvest your dividends in the fund. If you're not doing that already, that's an easy way. We're not sending dividends back, but we have to manage. An open-ended fund is a little bit challenging because Dave and his team are out there looking for deals constantly, and we're also taking money in on a regular basis. And deals, unfortunately, they don't happen on a cadence of closing every 45 or 60 days along the way. Sometimes you can go 3 months without closing a deal, and then 4 will close at once. And we just have to manage the cash drag in the fund. David, anything
Michael,
you want
I
to cover?
can take this one on preferred equity investments, having a conversion feature to common equity for any portion of the investment. Good question. We try and build this into all of our preferred equity investment structures to the extent that we can. And we do have, I believe, on 4 of the 7 investments, we have the opportunity to acquire the asset in a common equity position prior to the developer taking the project to market for sale. The thing to note on this option that we have, it's an option first and foremost, and generally they're structured as fair market value. So we can acquire the asset if we acquire it at today's established market value. And for the reasons we've discussed, which have been many on why we're not participating in the common equity market at the moment, is that we are struggling with valuations. And for us to exercise that option, we would have to pay market price. We won't get an edge in theory to the market, which is why we're so excited about that opportunity in Austin, because that represents real edge to market pricing today.
Thanks, Dave. This next question is about Monroe, Aberdeen, if we plan on selling or holding it, given that we're no longer investing in Chicago. And I addressed this, I think, on one of the earlier webinars. In Chicago isn't necessarily a sell to us, right? You have buy, hold, or sell. It's more of a hold, where we do like Chicago as a city. We're the dominant Midwest city. We've got great transportation, great infrastructure, universities, et cetera. You can't ignore the fiscal problems, but we went into this deal eyes wide open about what was happening with taxes. And in fact, we just got really, really good news on our tax situation. And in fact, I believe that we were assessed 24% lower than what our purchase price is. And so it's very favorable news relative to what we underwrote. And I would add, the business plan on that deal hasn't even really begun. So there's a lot of value to add in that deal. If you recall, we bought that deal with above market debt that really couldn't be defeased or gotten rid of because it would have been too expensive in the millions and millions of dollars. And the rate on that is about 4.3%. So we'll continue to evaluate that. And at the time in the future, if we can swap that debt into 3% debt, that property will have will produce a tremendous amount of cash flow. And then Dave alluded to this earlier, that West Loop, there's a huge parking problem, and we can charge for parking, and the previous owner never was. So there's still value to add in there. And Chicago has had a lot of strength. I mean, that property went from a low of 78% occupied to where it is today, which is almost above 97, 98%. So strength is abundant in this market today. And once we add value in that property and see the business plan through, then we will make a decision whether or not we want to sell it, and we'll reevaluate Chicago as a market. But the biggest risk factors have been underwritten correctly. We're actually getting favorable news on that property, and we're going to continue to add value. But thank you for your question.
Michael, I'll go ahead and take the question on the Smile States seeing a lot of development activity over the next 2 to 3 years, and our concern on if there's some oversupply. And a good question. And if you look at where development is focused in the marketplace across the country, it is predominantly in the Smile States. And it's for good reason. It's because those are locations that are seeing the strongest fundamentals, the strongest in migration trends, and the need for housing is actually the highest. And if you look at markets like Charlotte, that I'm sitting in here today, we've been averaging about 5% of new supply as a percentage of existing inventory, which is a metric that we look at quite a bit to determine how much supply is occurring in any given market and benchmark other markets against that. The interesting thing about that fact is that Charlotte has been averaging about 5% rent growth, effective rent growth over that time period. So what that means is that all those new units, even though that's a high percentage of new deliveries to the market, are getting absorbed, and there's more demand than there is supply. And we have a lot of metrics that we track, and we have a lot of analysis on development pipelines and demand. And we use our AI tool to calculate the demand side of things. So we're taking a very data-driven approach to analyzing these fundamentals, but we feel that these are the best markets to be investing in and developing in over the next 5 to 7 years.
Thanks, Dave. And there was a question about, I think, one of the slides that you had earlier, and it's what's the difference between build-to-core development and build-to-core and development?
I mean, it's just a nomenclature thing. I mean, that's what we're doing inside of this fund, and that we have a long-term hold strategy. So development can mean merchant build, build and sell, and build to core means we are developing this asset with the intention to hold it until the period of time it stabilizes and becomes a core asset and hold it long-term.
Yeah, I'm probably not asking the question right. I saw the same thing. This is from an anonymous. And the reality is that all of our development deals are build to core, that we're building them with the intention of holding them long-term. Will the scheduled November 2021 capital call still be processed? And this is for people who are in the queue today. And the answer to that is yes. We have decided that when we build a queue, and you should know this if you're listening, even for February, at a certain point, if the queue gets too big, we start another batch, if you will, right? And so there are people who have been in the queue since August, September of this year. We are going to be calling their capital in November with the December 1st trade date for deals that we're closing. And then anybody getting in today will be coming in February. And there's a chance that if you're not committing to the fund till January or February, that you might have a trade date that gets pushed out to April or May. So just wanted to clarify that. Thank you for the question. And then another question here about the queue. Where do you sign up for the queue? It's the same way that you invest with us. You fill out your subscription agreements. You will be in the queue. You have to go through somebody on our IR team. You can contact them at investorrelations@origininvestments.com if you don't have one. If you have a personal contact, please reach out to them directly. Rob asked the question, are there additional sidecars? Rob, we don't have any plans for additional sidecars because that part of the fund has been fully subscribed to. So we're not going to be doing any more ground up development deals. However, in January of next year, in 2022, we are going to be launching the Growth Fund 4, which is going to be all ground up development. And that's going to feature probably 12 ground up developments, and many of them are going to have sidecar opportunities. So if you like to invest in funds and individual sidecars on the development side, that will be an opportunity for you. And the reason why we had so many sidecars in the IncomePlus fund was really because we were allocating to that 20% bucket. But in the future, especially next year as the IncomePlus fund grows, we might add one development deal to the fund to make sure that we're complying with that 20% bucket. And we always have something in the pipeline in the portfolio there. Okay, last question, and then we're going to kind of sign off here. When do you expect visibility into what the final legislation will be? That's anybody's guess. I mean, that's up to the politicians right now to pass something. This bill is getting chopped up. Pieces are getting ripped out, revised, everything. And like I said, we'll know when you know. And then when we do find out, then we'll sit down and figure out if we're impacted at all, and then make some decisions then at that time. So thank you for your question. And Dave, I think that's it. So we can sign off, and we're actually a little bit over an hour right now. So it kind of makes sense. Anything else to add, or we're good?
No, great to be with you today.
Okay.
Thanks for having me.
You too. Yeah. Thanks, Dave. Thanks, Mike, for being on, and everybody else. We really appreciate your time today. And if you're a current investor, thank you for partnering with us. And if you're a prospective investor, thank you for considering Origin. And if you have any further questions, again, investor relations at origininvestments.com is a really easy way. You can go to our website. You can look at that. You can contact anybody. If you have a personal contact in the investor relations department, you can reach out to them as well. So thank you. Enjoy the rest of your day.